Do you really know what happens to your money when you die? Most people don't. And that's the scary part. You might think your savings automatically go to your family, or that your bank will simply figure it out. But that's not how it works in America. In fact, every single year, billions of dollars just vanish into the system, not because it's stolen, but because no one ever claims it. Your hard-earned money, your checking account, your retirement fund, even that forgotten certificate of deposit you left untouched for years, all of it can disappear. And here's the shocking truth. If no one claims it for long enough, that money doesn't just sit there waiting. Eventually, it becomes the bank's property. But before we get there, let's rewind. Imagine this. A man named Robert from Ohio had been saving money all his life. He wasn't rich, just an average middle-class American. He worked 40 years at a steel plant, owned a modest house, and had around $86,000 sitting quietly in his savings account at a national bank. When Robert passed away, he didn't have a will. He thought his daughter, Emily, would simply walk into the bank, show a death certificate, and withdraw the money. But when she tried, the bank said no. They told her that legally, the account was frozen. Without legal documentation, something called letters of administration from probate court, the bank couldn't release a dime. It took Emily almost 2 years of paperwork, attorney fees, and endless bureaucracy to finally get access to what her father had already earned. And here's the kicker. By the time she did, most of the money had been eaten up by legal costs and court fees. That's how the system really works. You see, in the US, banks don't automatically transfer your money when you die. They wait, silently. Your accounts stay open, but inactive. They collect dust, sometimes earning a few cents in interest, sometimes losing value to inflation. And after a certain period of inactivity, usually between 3 and 5 years, depending on the state, the money is reported as unclaimed property. That's when the game changes. The bank doesn't technically own it yet, but they're no longer responsible for trying to reach you either. Instead, they send it off to the state's Unclaimed Property Division, a place that sounds helpful but, in practice, functions like a black hole. Billions of dollars are sitting in these state-run lost money accounts in California, Texas, Florida, New York, Illinois, everywhere. Money from people who died, moved, forgot, or just never realized they still had something sitting somewhere. And the truth? Most of it will never be claimed. Why? Because no one knows it exists. Banks aren't required to track down your heirs beyond a few basic notifications. They'll send a letter, maybe 2. If no one responds, that's it. Your lifetime of saving gets boiled down to a line in a state ledger. Now, here's where things get darker. Let's say your family never finds out. After a long enough time, depending on state laws, the state may absorb that money permanently, or the financial institution holding it earns from the float, interest accrued while the money waits. It's a quiet process, legal, invisible, and it happens every single day. The federal government estimates that over $70 billion of unclaimed money currently sits in U.S. accounts. Unclaimed bank balances, uncashed checks, forgotten insurance policies, pensions, dividends, safety deposit box contents, and more. But if that sounds bad, wait until you hear what happens next. Because some of that money doesn't just disappear into government accounts. In certain cases, the banks themselves profit. Imagine this. A checking account in California has been inactive for years. The bank knows the customer has likely passed away, but there's no record of heirs. While they're holding that account before escheatment, that's the legal term for transferring it to the state, they're still allowed to use the funds. Banks lend it out, invest it, earn interest, and even though they'll eventually turn over the principal, the profit stays with them. It's a quiet win for the financial institution and an invisible loss for the person who earned it. Crazy, right? But it's all perfectly legal under U.S. financial regulations. Now, let's pause for a second. What if you have multiple accounts, maybe in Chase, Wells Fargo, Bank of America, or Citibank, across different states? If you pass away and your loved ones don't know about every single one of them, some could go missing forever. In 2017, a woman in Texas discovered her late uncle had over $250,000 scattered across 3 banks. Money no one knew existed until she stumbled upon a letter from an old credit union. Had she not found it, that money would have quietly been transferred to the Texas Comptroller's office, where it might have sat indefinitely, earning the state millions in collective interest from all such orphaned accounts. And it's not just bank accounts. The same applies to 401k, life insurance payouts, brokerage accounts, even PayPal and Venmo balances. If no one claims them, they're considered abandoned property. But here's the haunting question. What if you die today? How many of your accounts could your family actually find? Think about it. Your online banking passwords, your crypto wallets, your investment apps, your automatic deposits. Would anyone even know where to look? That's the silent tragedy of digital finance. In 1990, it was simple. People had paper statements. A banker knew your name. Now, your money lives behind passwords and two-factor authentication. And when you're gone, that virtual wall becomes a fortress no one can enter. Some families spend years trying to recover digital assets, and most fail. The bank may say, "We can't grant access without proof of authorization." But proof requires paperwork. And paperwork takes time, money, and luck. Here's a real story. In Florida, a retired Navy veteran named Carl passed away suddenly. He had $180,000 in a mix of online brokerage accounts and savings. He had told his son, Michael, that everything's set up, but never explained where. Michael spent nearly 5 years trying to trace his father's accounts through tax documents and email records. By the time he pieced it all together, 3 accounts had already been classified as abandoned property and sent to the Florida Department of Financial Services. He got most of it back, but not all. Some funds had already been liquidated. That's the system. Cold, bureaucratic, legal. Now imagine this multiplied by millions of Americans who pass away every year. Every forgotten savings account, every unclaimed refund, every stock dividend never cashed becomes part of a silent wealth transfer, not to families, but to institutions. So what really happens to your money when you die? The short answer: it depends on how well you planned before you did. If your accounts have payable on death, POD, or transfer on death, TOD, designations, things move smoother. That means the bank knows exactly who gets the money, and your heirs don't need to fight through probate court. Without it, the money gets stuck in legal limbo. And here's another twist. If your estate is large, federal estate taxes can take a chunk before anyone else sees it. In 2025, the federal exemption is around $13 million per person, but anything above that, taxed. And even if you're nowhere near that bracket, states like Oregon, Massachusetts, and Washington have their own estate taxes, sometimes kicking in at just $1 million. But that's not the part that keeps bankers smiling. The real gain for financial institutions comes from the forgotten middle class, the millions of ordinary Americans with $1,000 here, $5,000 there, small balances that fall through the cracks. When these go unclaimed, they get pooled, reinvested, or absorbed into the system. It's a slow leak that feeds the financial machine, and the banks know it. Which brings us to an uncomfortable truth. Your bank has no incentive to help your heirs find your money. They follow the law, yes, but they don't go beyond it. They won't track down your family. They won't call your relatives. They'll simply file the report, mark your account inactive, and move on. So if no one ever asks, the system wins. And if you're wondering, yes, there's an entire U.S. law for this. The Uniform Unclaimed Property Act. It sets the rules for when money is considered abandoned, how long banks must hold it, and when they must turn it over to the state. Each state tweaks it a bit. In California, it's 3 years. In New York, 5. In Texas, also 3. But the pattern is the same. You die, your money sits. And if no one claims it, it quietly migrates to the state treasury. Most states maintain public, unclaimed property websites, places where you can type in your name and maybe, just maybe, find a forgotten account. But only a fraction of Americans ever check them. So the cycle continues. Now, think about this. Your entire life's work, reduced to a forgotten login or an unclaimed check. The bank waits. The state profits. And your legacy fades. But here's where things take an even more surprising turn. What happens when banks themselves die? Because yes, banks die too. When a bank dies, your money faces another twist in its journey. You might think the federal government just steps in and gives everyone their cash back. But that's only half true. When a U.S. bank collapses, like what happened with Silicon Valley Bank in 2023 or Washington Mutual back in 2008, the FDIC, or Federal Deposit Insurance Corporation, steps in. Their job is to protect deposits up to $250,000 per depositor, per bank, per account type. But here's the catch. That coverage only applies to accounts that are active and properly titled. If you die and your heirs don't claim your money or even know about it, it can get lost in the shuffle during a takeover or liquidation. So, imagine your account is dormant, your estate is in probate limbo, and your bank suddenly collapses. Your balance might be eligible for protection, but no one's around to claim it. Guess where it ends up? Back into the same unclaimed property system we talked about earlier. Round and round, the money goes, vanishing into the bureaucratic maze of the U.S. financial system. Let's step back for a second. You see, the U.S. banking network is one of the most complex financial ecosystems in the world, with over 4,000 banks and 4,000 credit unions, each governed by a web of state and federal regulations. That means when someone dies, their money isn't handled by the system as one body. It's handled by individual institutions, each following its own procedures, timelines, and policies. Some states, like California and New York, are relatively strict, requiring banks to transfer unclaimed funds to the state within a few years. Others, like Delaware, are looser, giving banks more breathing room. And guess where most major corporations are incorporated? Delaware. Coincidence? Probably not. Now, here's something most Americans have never heard of. In some states, the government actually uses unclaimed funds to balance budgets. That's right. Those forgotten savings accounts and uncashed dividends become part of state revenue. California, for instance, has held tens of billions in unclaimed funds for decades, and every year, the state uses the interest from that money to fund public projects. So while your unclaimed inheritance technically belongs to you or your family, it's quietly working for someone else. This is why some experts call it the quietest wealth transfer in America. Not from rich to poor, not from young to old, but from the dead to the system. And it's been happening for generations. Back in the 1970s, before digital banking, most people kept physical passbooks, those little blue or green bank books with stamped balances. If you lost one or never told anyone where it was, that money was as good as gone. Today, it's the same story, except instead of lost passbooks, we lose passwords. Every year, millions of Americans die without sharing their financial logins or digital access credentials. And here's the thing. Under U.S. privacy laws, banks can't just hand that information to your relatives. Even if your spouse walks in, even if your children beg, the bank will likely say no unless they have a court order or are listed as a joint account holder. That's how people lose not just thousands, but sometimes millions. Take this story. A woman in Illinois inherited her father's estate, but had no idea he'd invested in a small brokerage account 20 years earlier. By the time she found out, the account had long been liquidated. The money was turned over to the Illinois State Treasurer's Office, where it sat unclaimed for over a decade. When she finally applied to reclaim it, she received the original principal amount, but none of the decades of growth it would have earned if it had stayed invested. The bank and the state had both already profited from it. And that's one of the most painful parts of this entire system. Even when your family finally finds your money, they rarely get the full value back. But let's open another loop here, because the story goes deeper than just lost accounts. What about cash and safe deposit boxes? That's right, the little locked drawers inside banks where people keep jewelry, documents, or bundles of cash. What happens to those when you die? Well, if your rent for that box goes unpaid and no one claims it for years, the bank drills it open. The contents are inventoried, sealed, and eventually turned over to the state. Some items, gold coins, diamond rings, rare stamps, are auctioned off. The proceeds are added to, you guessed it, the state's unclaimed property fund. California once auctioned off a collection of rare baseball cards found in a forgotten safe deposit box. The owner had died in the 1980s. The family didn't even know the box existed. By the time they found out, the cards were long gone, sold to collectors around the country. The money from the sale? It sat in a government account, earning interest. Now, let's zoom out and think about what that means for your own legacy. Every day, Americans are told to save for the future, to be responsible, to put their faith in banks, retirement accounts, and long-term investments. But no one talks about what happens when that future never arrives. Your lifetime of discipline can vanish in the shuffle of legal paperwork and forgotten passwords. And in the end, the institutions you trusted the most, the banks, the states, even the government, become the silent inheritors of your life's work. But there's a way to change that, if you act before it's too late. Here's how the insiders protect their wealth. They don't just open accounts. They structure them. High net worth Americans use something called beneficiary designations and revocable living trusts. It sounds complicated, but it's really just a way of saying, my money goes exactly where I want it, automatically, no court required. When you set up a trust, your accounts skip probate entirely. No waiting for judges. No frozen funds. The moment you pass, your trustee, someone you chose, gains control of everything. And for smaller accounts, adding a payable on death beneficiary at your bank is free. All it takes is a few signatures, and it can save your family years of chaos. But most Americans never do it, because most never think about what happens after they're gone. That's why, every year, more and more money ends up in limbo, sitting silently in accounts across the U.S., from California to New York, Texas to Florida. Billions of dollars that no one ever touches again. And if you think the bank's mind, think again. Dormant funds help their balance sheets. They reduce withdrawals, increase liquidity, and make quarterly numbers look stronger. It's not in their interest for you, or your family, to take that money out. So the machine keeps humming. Let's pause for a second and think about that. The average person works 90,000 hours in their lifetime. They save, they invest, they hope their family will be okay. And yet, with one missed form, one forgotten password, or one unchecked box at the bank, it can all end up in someone else's hands. That's not a conspiracy. That's the fine print of the American financial system. But let's go even further. Because not all the money that disappears comes from individuals. Every year, corporations, small businesses, and partnerships also leave behind abandoned funds. Payroll checks never cashed, vendor payments never claimed, refunds lost in the mail. All of it ends up in the same pot. So, when you hear that states like California hold over $11 billion in unclaimed property, or New York over $18 billion, that's not just from forgotten checking accounts. It's the accumulation of decades of financial silence. And while states claim they're holding it safely, the truth is, they're using it. Now, here's a secret most people never hear. If you dig deep enough into state financial reports, you'll see unclaimed property listed as a liability on paper, but the cash itself is often mixed into the general fund. That means your unclaimed inheritance could literally be helping to pave a highway in New York or fund a public school in Texas. Strange thought, isn't it? That your hard-earned money could end up paying for something you never even knew existed. So the next time you walk into a bank, remember this. That quiet vault, those polite smiles, the smell of polished marble. It's all part of a system designed to hold, protect, and sometimes forget. And it doesn't care who you were. Whether you were a billionaire in California or a schoolteacher in Kentucky, the rules stay the same. When you die, your money stops belonging to you. And if you don't make it clear who it belongs to next, the system will decide for you. Now imagine this. You're gone. Your family sits around a table, sorting through papers, old files, tax returns. They find accounts they didn't know existed. A letter from Wells Fargo. An old 401k from a job you left 20 years ago. A PayPal account with a few $1,000s. A small certificate of deposit from Chase Bank. Each one becomes a mystery. And every mystery means more waiting, more red tape, more time. Meanwhile, somewhere deep in a server room in Delaware, a line of code quietly marks your account inactive. No emotion, no ceremony, just data. That's how most stories end, not with a bang, but with silence. But maybe yours doesn't have to. Maybe, before the curtain falls, you can make sure your money has a clear destination, a purpose, a plan. Because if you don't decide where it goes, someone else will. And the bank will be more than happy to take care of it for you. So, do you really know what happens to your money when you die? Now you do. But the real question is, what will you do about it before it's too late?